Tip of the cap to you folks, and welcome to the special edition only for our Premium Platinum Plus VIP Select Club level members.
Dang.
We're calling it Winter is Coming. Now, I know your friends may be asking you, how do I become a Premium Platinum Plus VIP Select Club level member? Well, it's simple. You simply download the podcast on iTunes, Spotify, and somewhere else. I can't really remember.
Stitcher Radio.
Stitcher.
There you go, Stitcher. And you'll have access to over 13 podcasts of Premium Platinum Plus VIP Select Club level content.
And go to
Obviously, I'm just
YouTube.
kidding.
YouTube.
Yeah, and YouTube. Yeah. Obviously, I'm just kidding. All of our listeners are Premium Platinum Plus VIP Select Club level members. So tell your friends and they can become one too. All right, enough of that. I'm your host, Wealth Manager Rob Eklund.
Nice.
Some people that I don't like very much call me Rubber Mallet. With me today, we have the Godfather, certified financial planner, Charlie Mattingly. Welcome, Charlie.
Yes, sir.
And of course, our executive producer and vice president of podcasting, Mr. Cowbell, Ben Dickinson. Welcome.
Nice.
Good to be here. Thanks for the title
Crowd-
upgrade.
Crowd
You
goes
betcha.
wild.
You betcha. You've earned it, buddy. We're going to start off with the joke of the day. Hold on. All you CPAs out there, Kevin, we apologize up front. But here it is. How do you know if your CPA is an extrovert? Because
He's
he
not a
looks at
CPA.
because he looks at your shoes when he's talking to you. That's courtesy of Chris Radkin from 2 West. Thanks, Chris.
Nice. That's an outgoing CPA right there.
yeah.
Too funny.
Fantastic. Let's get into some aviation news. Charlie. what
All
do we
right.
got?
Excellent. Excellent. So everybody loves top 10 lists. So we have one. We found one on bitluxtravel.com. Top 10 pilots of all time history. I know everybody's dying right now to know.
Yes.
Heck yeah.
Are we on it? I mean, that's
Is
what everybody wants to know.
Well, there's a guy named Charles on there.
Yeah.
That-
Not
Lindbergh.
Mattingly. Top 10 greatest all-time great pilots in history, according to bitluxtravel.com. Now, let's see. I think we start with number one. Which ones? They didn't number them. Yeah,
wait,
it's
they
got to
didn't
be.
Well,
I'm going to
Wilbur-
start with number
yeah.
10 then. All right. Ready? Number 10. Well, let me share my screen with y'all so the folks on YouTube can kind of play along with us here.
Yeah.
So here we go. Number 10, Robert Hoover. Robert Hoover. Bob Hoover. Does anybody know anything about Bob Hoover?
Oh, yeah.
Bob?
I'm reading here. He's from
he's a
Nashville,
giant.
Tennessee.
A giant in the community.
I've seen him in every air show I've ever been to, and he's always flown this multi-engine, like corporate airplane. And I'm like, that's the weirdest thing ever. It's it's impressive, but I had no idea he was like an Air Force fighter pilot during World War II.
Oh, you didn't know?
I didn't
you
know that.
Charlie? Oh, man.
Yeah.
He's incredible. I love the little spiel there about him becoming a POW and then stealing a German plane, and flying it out of there. That's
Wow,
You should
I
make a
had
movie
no
about that. They
idea.
probably have. I haven't seen it.
Am I talking about the same guy that does the air shows? You know what I'm talking about, right?
Yeah, it
You've
is.
seen him
You
before.
are. Yeah.
But man, it's decorated. He's crazy. So, all right, that's number 10. Number 9, Eric Hartman. I've never heard of Eric Hartman. He became famous as a fighter pilot during World War II. Hartman was a German fighter pilot who would eventually become known as the best in history. He flew
Oh.
1,404 combat missions down 352 enemy aircraft, including 7 American fighters.
Sounds
Greatest-
like a
You
bad
know,
pilot.
this one
Evil.
I might have to throw in just because he's not there, and we already talked about it a little bit in the pre-show
Yeah.
prep, was General Robin Olds isn't on the list. I
Yeah.
might throw him in there.
Yep, that's
Yeah,
In
right.
lieu
take-
of Eric Hartman.
We could
Yeah,
replace
take off
him.
the German.
Yep, that's right. All right, number 7, General Chuck Yeager. Chuck
I
Yeager,
flew him.
retired U.S. Air Force fighter pilot. 1947 became the first pilot in history to have traveled the speed of sound, reaching 1 Mach 1.07. Living to tell about it.
I flew him on a Southwest flight. No
Did you
big deal.
really?
No big deal. I
How
flew
was the
him.
landing?
It was pretty good.
Pretty good?
I'd say strong to quite strong.
Wow.
Truck wouldn't have been happy. with
Sacramento.
it.
Wow, too cool. All right, help me keep track here. Number 6, Chelsea Sully Sullenberger.
Yeah.
All right, we know. I think we all know about Sully. Landed in a river somewhere and and everybody was saved.
And he went to the prestigious United States Air Force Academy
Air Force Academy
as well. Yeah.
They have an academy for Air Force pilot?
How dare you?
I'm just.
He flew F4s in the Air Force, if I'm not mistaken. I don't see that on here, but
Yeah, he did.
yeah, okay, yeah, that's I don't know. I mean,
I think it's a contemporary list.
he did a good job. I think there's some recency bias going on there, quite honestly.
Mm-hmm.
It's recent, we remember it, so he's on the list. Otherwise, I don't know.
Great
Any
nickname
kind-
too, Sully. I mean, come on,
Sully,
people
yeah,
like that.
yeah,
That's,
great.
That helps.
All right, Noel Vine. He must be German too.
He's
He's American.
I mean, we got an Academy guy. We got an Alaskan on here.
American aviator introduced the airplane to Alaska.
What?
Alaskans have more airplanes per resident than any other state. Take that.
Wow, that's great.
Texas.
He was known for his resilience, which needed to establish a commercial airline of frigid Alaska. That's crazy. He reportedly still flew and diagnosed with polio, and even continued to fly after losing one of his eyes due to injury in 1940s. Wow, crazy. Okay,
How did he pass
faster
the health exam?
Yeah, no kidding. You fail a FAA exam like that. Refer to our last podcast, right? If you're
On
disabled.
disability. Yep.
Yeah.
All right. Faster, funnier. General James Doolittle. Wow, we know about James Doolittle. Holy cow, he is definitely deservedly on the list. Baron Manfred von Richthofen.
Another German on
Another
there.
German. The Red Baron.
wow.
The Red Baron.
They named the
Okay,
pizza
well,
after him.
Fair
Yeah.
enough. Yeah.
Must be
Could
good.
be. Yep.
Amelia Earhart. The ladies are represented. Awesome. Very, very high on the list was Amelia Earhart, born in Kansas in 1897. She shook up flying in her 20s. No, she took it up. She didn't shake it up. She took it up.
Well, kind of shook it up too.
I was going to say that's
true.
That's relevant.
First
She shook it
female
up.
to fly across the Atlantic by
Yeah,
herself, right?
that's incredible. General Charles Lindbergh. All right, we know him as well. So, third most well-known pilot in the world, Charles Lindbergh got his start in aviation as a parachutist and wing walker. So, Charles Lindbergh was not the first transonic flight ever, but it was the first solo flight of its kind. So that's pretty cool. He went to the
Medal of Honor?
Looks like he went to West Point. He reached the rank of Brigadier General. Like you said, Ben, Medal of Honor 1927, Distinguished Flying Cross 1927, and the Congressional Gold Medal 1928.
Dang.
Number one, any guesses?
This is
Two people.
kind of
Two
yeah.
people. Wilbur and Orville Wright. Number one. I forgot to wait for the drum roll there. Most famous of all pilots, known as flight pioneers. The Wright brothers invented, built, and flew the world's first successful motorized airplane. Took off from Kitty Hawk December 17th, 1903. The brothers also invented aircraft controls, making fixed-wing flights possible. Wow, pretty cool.
Yep.
That's cool.
Pretty
Yep.
cool.
We'll have
Wilbur
to
and
come
Orville.
up. Maybe next time we'll come up with the top 10 all-time great pilots in movies.
Ooh.
Oh, actors that played pilots.
No, just their characters. I think.
Okay.
You
gotcha.
know, Ted Stryker,
Oh, that's right.
Goose. Well, he wasn't a pilot. Never mind.
Nice.
Disregard. All right. Excellent. I like it. Anything else
Mhm.
on the aviation news front?
No, I think Ben's got something though. Or at
What
least
do
he
I
told
got?
me he did.
What do
The
you got,
shout-out.
Ben? Anything? Shout out?
I got a shout out. I do have a shout out. I got a shout out our own COO Lisa
Yep.
and all the Marine spouses out there. We had some she was filling us in on some pretty actually really awesome stuff about what's going on in Afghanistan, and she's a part of a Facebook group of Marine spouses that help to try and bring some people some translators home, and really did some awesome work. She was sharing us some stories from there and some Facebook posts, and it was really incredible.
Yep.
Did you
fascinating.
guys get a chance to read those?
Absolutely. Yeah.
Yeah.
I'll help you out, Ben, since we set you up for failure on that one.
Yeah.
But no, it's pretty amazing what's been going on. It's been pretty tragic, since mid-August. All hell broke loose in Afghanistan. We're going to avoid talking and placing blame right now and avoid politics right now, because what's important is that we get people out right now. We can talk about the other stuff later. Now, what's cool about this situation is that there's a Marine Corps USMC officers spouse group on Facebook, and they put all that other stuff aside and they said, let's do something. And so these gals, and I'll say gals because they are, and most of them have Marine Corps husbands on the ground, either over in Afghanistan or, helping out at state departments in various places. So this has just been amazing. And to the crux of the story here, these spouses got on Facebook and they said, all right, we're going to coordinate to locate people in Kabul and we're going to get them the heck out of there. So, I mean, how does that happen? I mean, that's awesome to those girls in that group, those spouses group, because let me just read a couple real quick here. And this is they're just coordinating, talking and communicating to people through WhatsApp, Facebook, phone, whatever, anywhere in the world, anywhere in the country. One of them says, hello, I need some help. I need the help of some miracle workers. My husband's interpreter's family is entered by the water canal outside the Abbey Gate at the Kabul airport. My husband has worked with the State Department. I believe all the paperwork is complete. The family's name is, and this is the Afghani family, they're carrying white papers that say professional. The Taliban has been searching for them and they are desperate. I have phone numbers and copies of letters if needed. So there's just hundreds of these messages going on and on, back and forth, like, hey, there's one here, update, please help. We have a translator's waiting at the North Gate. He and his family are trying to get through. It's him, his wife, and 5 children. Can anyone help? He has a passport. They are desperate. The situation is worsening. And we knew, last Thursday was terrible. And, but this was prior to that. So they're getting people out of there. You're not going to see this stuff on the news. And again, you're going to see bad stuff on the news. We need to hear that stuff too. It's important. But this stuff is just ladies making it happen and getting people out of there that helped the U.S. for the last 20 years, U.S. and the allies as well. The last one I'll read here is just a really cool meme of, and I'm not going to share this on our screen we don't want people's names up here and all that kind of stuff. But one of the spouses posts a meme with a little baby saying, yes. And the baby says, excuse me, not the baby. The spouse makes a comment on Facebook and says, holy hell, y'all, our guy is safe. Our guy is safe. The Marine Spouse Mafia has pulled off something the State Department and multiple other groups haven't been able to do yet. This group can move mountains and we could run the whole damn world. So I think that's really cool. Hats off to those Marine spouses to just step up and take the initiative and get it done. I mean, that's incredible. I just can't even say enough for those that took part in that and the difference that they made. And even if it was one life they got out of there, one person, it was many more than that, but they saved lives. I mean, that's just incredible.
That is incredible.
Yeah. Yeah, it really is. And not to downplay them, but just there's so many groups that were doing that too and helping out and trying to find people and just it really, the amount of there's a lot of power. We have a lot of power if we team up and, we can get a lot done and it's pretty inspiring.
It is. Pretty cool.
Just for a moment here, let's take a second to remember the Marines that actually fell during that Afghanistan. I guess we're recording this in August 30th, 2021, this last week. So we're going to take a moment of silence here and just remember them. It's pretty extraordinary what our servicemen members have gone through, and thanks for sharing that, Charlie, and looking that up because it's super important. So,
absolutely,
thanks for that. We're going to move on now to our financial topic of the day, which is comes out of the Game of Thrones. Obviously, winter is coming. A market downturn will happen. We don't know when, we don't know for how long, but we can say with confidence, which we don't say a whole lot necessarily in this business, but we can say with certainty, I should say, that a market downturn will happen. Charlie, what do you think? Let's define this. Let's start putting let's start filling in this picture a little bit. Let's define what is a correction, a recession, a depression? What do you think? What do you got on that?
Yeah. So if you look at the headlines enough and look at the news enough, which I've kind of tapered off over the years because you see the same headlines over and over again. So-and-so expert predicts, so-and-so expert predicted. So it's really a way to sell newspapers, and those places have to sell commercials and ads and such. Yeah. So they get on there and they talk about this, but it happens all the time. So let's talk about a correction. The correction is coming is going to be a headline. Just go ahead and put it out there, Ben. Put me on the headline somewhere. It's predicting the next correction. It's going to happen. Correction is defined as a 10% decline, or more, I should say. So guess what? Let me share something here just with our YouTube folks. Maybe they can see this, but corrections happen almost every single year. In fact, it's a really rare exception when they don't happen, because on average, it happens every year. And let me just read this. This is from JP Morgan Asset Management. They update this every single year, and I find it fascinating. So basically, in fact, let me just correct here. Every year, we average 14.3% decline within the year. So it's intra-year, not calendar year. It just so happens that we as human beings like to look from January to December. The stock market does not care about January to December. It happens anywhere in between all the time. So let me read this slide real quick. Despite the average intra-year drop of 14.3%, annual returns were positive 31 of the last 41 years. And I think this is data from 1980. Here it is on the slide here. 1980 to 2021, we're still going as far as the data. What do you all think about that?
Yeah, I just to kind of wrap that up a little bit, or the point here, I'm going to steal from Tony Robbins a little bit. His book Unshakable. He's got freedom fact number 1 on when we start talking about declines, and it's on average corrections have occurred about once a year since 1900. So even if we go back farther, once a year since 1900, it's just we tend to look at the stock market. If you look at the graph of the stock market, we pull back, and when you pull way back and you look at it from the 100,000 foot view, it looks like everything's going up, everything's great. But if you zoom in, that's when you see it's the Rocky Mountains out there. Things are going up and down and sideways, and I think a lot of people, if you know that, it's easier to weather the storms.
Yep, absolutely. Go ahead, Ben.
Yeah, I remember looking back just to the beginning of March of last year, and I was looking at, how could I not tell that the COVID was going to happen and crash the economy? And then you look back, and it's like down 7% one day, up 5% the next day, down 6%, up 8%, down 10%. It just goes up and down. But back in my head, it's, well, all of a sudden on March 23rd, the stock market just crashed, and that's not exactly how it works. It's over the course of a few days and maybe a week. But yeah, like you said, you zoom in, you see that it's a lot harder to really predict these than when you kind of zoom out and look at it from a macro scale.
So I think it's important. This is kind of leading right into the next definition, which is a recession, right? So we have a correction, decline of 10% or greater, and
which happens basically every year.
Yeah, happens all the time. And then a recession, right, is a little bit worse. It could be a lot worse, I guess. But it's defined as at least 6 months or 2 quarters of a negative GDP, generally identified as a falling GDP, or 2 consecutive quarters of economic decline. So that's a recession. And those happen as well, often.
Yeah.
Yeah. Do you guys, was that last year? Was that even officially a recession?
The shortest one on record.
Shortest one on record? Okay.
It was 2 quarters of GDP decline.
Yeah. And so the interesting thing about recessions is most of the time we don't know we're in one until it's almost over. And we certainly don't know we're out of it until way later.
Yeah.
Exactly. So it's it can't even be identified until until it's been going on for 6 months. You can't even technically consider it a recession.
Yeah. So that's the fascinating thing about, what do we do? Well, it's like, you don't even know you're in one. The information is so delayed. And oftentimes the economic board, I forget their official name, they'll go back and they'll revise that. They'll change it, for several quarters afterwards as well. So it's just really hard to take action on those kinds of things. Because, even if we're in a recession or there's going to be a recession, if you don't know the exact timing of that, which again, like we just said, we don't know until after the fact.
Yeah, you're not going to.
It's not usable information.
Right. And so a recession happens on average since 1900, every 4 years. But it's not like clockwork. It's not like you can set your watch, 4 years from now, there's going to be a recession. You can't do that. It's a boom and bust cycle, and it's changing all the time. Right now, I think we're in one of the longest expansion periods on record. Maybe not right now because of the COVID, but prior to that, it was one of the longest expansion periods on record, and it changes. So we just don't know what's going to happen.
Yeah, Rob, I think one of the fascinating things too is, we're going to talk in a few minutes about what to do. How are we successful going into, during, and out of a recession or a correction or whatever it might be? There are things that we can do. We don't have to sit on our hands, which is really nice to know, because I think that's what drives people crazy. I feel like I should do something. In fact, the action that people tend to take is sometimes destructive. We'll talk about that in a minute. We don't believe that you can time these things. We don't believe you can time COVID. I think we learned that. I think most people would agree. Although at this moment, we're probably now starting to hear about people that, they did know the top and the bottom.
Sure
but
they did.
Last March, I didn't hear anybody proclaiming the bottom at a time. I was listening. I promise you, I was listening. So what happens, what happens during these times? We get emotional. We get scared. We want to pull our money out, right? That's the action that we want to take. We don't think that's the right action. We think that's very risky to pull all your money out of the market.
No.
The reason I think it's risky is because when do you get back in? And so I pulled this slide, Rob, you and I did that, what lies ahead. And this is a great slide. Let me try to give the proper credit to people here. This is Visual Capitalist, the advisor edition, I think, advisor.visualcapitalist. And they're really amazing information. So you guys
great
tell
slide.
me.
It was a terrible YouTube. So I don't think we put it out. But great slide.
Let's go look at that. But you all tell me, when are you going to get back in the market in 2020? Was there a good time? I mean, April 3rd, global COVID surpasses 1 million. April 20th, oil prices go negative. We had protests. We had violence all through the summer. Did you all know on July 28th, Iran fires a mock U.S. aircraft carrier? So I'm assuming they didn't know it was a mock aircraft carrier. I don't know. Wow. But you didn't hear about that. Record wildfires last August. Oh, by the way, there was this little thing that happened, in early November, called the election, right? So are you going to get back in or just prior to an election that was as divisive as last year?
Yeah.
What do y'all think?
Yeah. I think, and like you said, this is like, when do you get back in? Okay, you may wait. Okay, I'm going to wait a month and see how things are. And then you're like, oh gosh, oil prices go negative for the first time. You wait another month. Oh, okay. Well, now we're getting all these riots. And next month, Iran. It's just every time there's always an excuse and a pretty good one to not get back in, actually. I mean, if I heard about that Iran thing, I'd be a little scared.
That's right.
I know we're going to get to this in a second, but if you're getting out too, you're missing out on buying when things are low, when stocks are low. And, just to think about it, a full cycle, if you will, of the economy lasts about 4.7 years. It's 3.2 on average. Again, these are averages, 3.2 years of growth, and then a 1.5 year recession. So that's kind of the cycle that doesn't happen exactly like that all the time. It's obviously the averages of this. So you just don't know when things are going to happen. So if you're out, I mean, the market can turn really quickly, and it's erratic, and the downturns can be deep. And if you're out, the upside can be very steep. Obviously, is definitely if you're looking at the YouTube, it's a V-shape recovery in the stock market.
Yeah, Rob, those are great points, man. I love that the statistic. We use that a lot, and when we plan for people's retirements, they need income in a few years, let's say. And my mom retired in 2020, so she's the perfect case study. And we didn't have to sell anything. because she was prepared for that. Like you just said, about a year and a half is the average. We double that, we triple that. We make sure that someone has secure income just prior and into retirement so that they don't have to worry about the stock market going down. It's not relevant. Even if you're in retirement, you're still an equity investor, but you have safe enough assets such that your income is not going to be compromised if we have a recession. It can't be. We have to plan for that, and we do. And what I have right now up on the screen is what it looks like in real life. And you hear stories, you're going to hear stories and fly with people. I got out in March, I don't know, whatever the top was. I got back in late March. It's hard to believe that could be the top and the bottom. I'm going totally off the cuff, but it's not far off. But, most of the time, and in fact, that's just luck because there was no way to know it. I promise you, I was looking every second of every day to try to figure that one out, as everybody was. But most of the time, this is what happens. This person that you're seeing on the screen here, and we'll talk to it here, they stayed in the market. It was tough. It was like a, 12-round boxing match. You're getting pummeled all year long, basically. And Ben, like you mentioned earlier, if you look at the month-by-month return, it was nasty. And it was nasty until about, midsummer, late fall. In the last 2 months of the year, knocked it out of the park. This person stuck with it because we went into this, 2020 with a game plan. We knew when they were going to retire. We knew how much they needed to be safe. Nothing was compromised. Their retirement goals were intact. They stayed with it. We were proactive when we were prepared for this, even though we didn't know what was going to happen or when. So they were up. They finished. They had a conservative portfolio. They were up pretty decent. So this is what it looks like. You stick with it. It's hard. It's not easy. You want to do something. There are other things to do. We're going to talk about.
And on screen, we're seeing an 8.2%. Over that time for
not quite the full
January
year
to December.
And that's a dollar increase of about $100,000 on the screen there.
And just to clarify for our podcast listeners, we're looking at a slide that shows this is an investor who stuck with the market, and at the end of almost the year here, they were up 8.2%.
Yeah, about $100,000 in dollar terms. So it's hard to believe that you could go through a year like that. We just talked about all the stuff that happened, but yet we're up. Similar person, very similar time frame, very similar asset level, decided that they were going to get out, and not just like, hey, I'm not afraid, but I want to get out, and then that way, if it goes lower, I can reinvest back in, and like talking about this stuff that's really not reasonable to do or execute for that matter. Because Ben, what you said earlier is goes down one day 10%, up 10%. We had multiple days like that last March, April, and maybe even into May. So getting a clear picture on that while you're in that battle is nearly impossible. Is this the day that I rebalance and sell my cash and go back at, it's just not clear ever during the fight. So this person really never found the entry point. And they exited probably right at the bottom, March timeframe, and then just waiting for the time to get back in. There is no time. There's never a great time to get back in. Finally, in November, December timeframe, the money goes back in. End up with minus 4%, dollar value down about $45,000. So again, two investors. The difference there is about $145,000 swing in that 1 year between investor A and investor B. Again, that's just a case study. When people tell me, hey, hey, the market's up right now this year to date. I don't know what it is exactly, but it's up. Hey, I want to get out right now because, like you said, Rob, the storm is coming, the winter is coming, and I just want to preserve the gain that I have. Okay, that's logical and reasonable, right? But then my next question is, well, when do you get back in? Do you stay out forever? What's your trigger? What's your magic signal? There is none. And getting back in is the challenge, and that's where people lose. I'm okay with taking your 10% rate, return and running, but how do you get back in? That's where people really lose. Just like you're seeing on the screen that we're showing, it's $150,000 difference in two similar investors, and I don't think you can ever get that back. You all, am I wrong? How do you get it back?
No, you don't get that back.
Yeah,
and you're gonna suffer for that. Hopefully, you learn from it, and you don't make the same mistake when the next downturn comes, which we know is coming. obviously. So those are the tale of the two cities, right? Two people right there,
Yeah.
$150,000. And the percentages on those are 3.9% and 8.2% gain versus the loss of the 3.9%. And that is why even for the folks, again, we're looking at a slide where the guy got out, or guy or gal got out at the bottom of the market and then tried to get back in at a certain point, and it's a perfect example of they sold when the stocks were low and they bought when stocks were high, and the exact opposite of what you want to do. And it just goes to, the whole thought process that's been spouted several times, but we can't say it enough. Nobody can consistently predict whether the market will rise or fall. And even for the folks that timed it perfectly, say you timed it perfectly and you got out right before COVID happened, the chances of you timing it perfectly to get back in are slim to none.
Yeah. Yeah, you're right. And that's a great transition, Rob, into, well, what does this look like in real life? When I get out of the market, when the news headline is scary, and I get back in when the coast is clear, which those two things we don't know, so what does that look like? Well, I can tell you, to get out of the market when things are scary means you go in your account and you sell Apple, Amazon, you name AT&T, whatever company, mutual fund, I'm talking mutual funds, ETFs, if you own individual stocks, you're going to sell that stuff. And you're locking in losses. When you sell it, people say, I want to be more conservative when things get bad. Well, if you wait till things get bad and then you become more conservative, that means you're selling and taking a permanent loss. And people say, no, it's not permanent because it's going to continue to go down. Then I'll reinvest my cash. Well, no, it's going to be, never happens the way we think it's going to. For example, 2020. So the average investor does very poorly. This is the average equity investor, about 3% from the 20-year period of 2001 to 2020. The average equity investor, according to this JP Morgan slide we're sharing here, I think the information comes from Dalbar. So now there's some of this information is debatable. Maybe they didn't take into consideration costs of investing, et cetera, but nonetheless, the point is clear that by becoming more conservative during scary times, we sell low. If we get back in the market, we're buying high later on down the road. So that's what it looks like in real life. But the language we use sounds so much better. I'm going to get out, I'm going to get back in later. That sounds pretty cool.
Yeah,
Selling at a
good.
loss sounds terrible. And that's really the reality. So,
and if you think you somehow are one with the market, just realize that some of the smartest hedge fund managers in the world have tried to do this and failed, and they continue to fail. Again, no one has met anyone who can consistently time the market. No one has met anyone who's met anyone who can consistently time the market. And some of these people, these hedge fund managers who've got, Harvard degrees, tons of letters behind their name, access to all kinds of information that you and I will never dream of having, have failed to time the market. So you're probably not going to, you're not going to probably do it. As much as I want to be optimistic, that's probably not going to happen.
Yep.
Great. Yeah, we saw it last year a lot. With these, it was across industries and across the entire market, across the globe. So what are you going to do? You think you sell out, and then where are you going to be tactical? Where are you going to buy into? What it's what are you going to replace your funds with? You go to cash and hold out. There's no return. Like, what do? You gotta be in the market.
Time in the market, not timing the market, like we always say. And I think this is perfect. It goes right into, okay, this is what people have done. So how do we prepare? What do we do? Obviously, we're pilots. So I talk about that. We always talk about simulating it, chair flying it, be ready. We know winter's coming. We know a recession's coming. We know a correction's coming. So we need to be ready for that emotionally because of, since caveman days, our emotional response to those kind of fight or flight scenarios is usually wrong when it comes to investing. But if you're ready for it, then you can be, you take the emotion out of it and get through it. Charlie, what are some of these strategies that we use so that we can do well even in the downturn?
That's right. Yeah, I'm sorry to keep interrupting there, but I'm just dying to jump in and get at it because
Go.
because there's a lot of stuff we can do, and that's the misconception is like you just sit on your hands and put up with it. Well, and people say, "Are you passive?" I'm like, well, what does that mean? I hate that word because we're proactive. We're going to plan, and like in the flying world, we're going to chair fly the heck out of this. That's an Air Force thing, maybe I guess, but we're going to practice. We're going to run simulators. We're going to talk about it. We're going to study it with our clients. And we're going to show them and what it's going to look like when this does happen. Hey, and I think it is like flying. There's some mental preparation. There's some value to that mental preparation because Rob, you said emotionally it's very difficult once it happens. And Ben, before we got on, you're talking about, hey, people that have poor balance sheets, they suffer a lot because the stress is multiplied. If you're a person that's got cash, paid off your debt, you're saving, a recession is a little bump in the road. Maybe it's stressful, but you're buttoned up. You're good to go. In fact, I showed you all a text. A friend of mine always has way too much cash because he's afraid to do anything with it all the time. So I texted him last March 2020 and said, Jason, put your money to work now. It's mid-March and it was still nasty. And he said, no way. No way. I said, look, if you've got cash, there is no recession. If you've got a strong balance sheet, get your money to work. Now's the time when you make money, but it's hard, really hard to do. So what does that simulator look like? And I've got something on the screen here, but I'll also talk to it. But basically we simulate people's lives. What's important to you? What do you want to do? What does retirement look like? What's your vision? Then we put price tags to all that stuff. It's like, this seems like an exercise and, wasting my time, whatever. But it's important to know what you want to do in retirement. It's important to know how much that's going to cost. Then, like the simulator, we're going to fail an engine or two. What if now we have a bad stock market? What if we have a bad stock market when you're 50? Well, not a big deal. We can survive. We can be fine. What if you have one when you retire from the airlines at 65, current retirement age? The year you retire, like in 2008, when the retirement age was 60, we had a lot of pilots retiring right into 2008 at age 60. I'd like to be those people. So that's one of the bad timing scenarios that we run because it is one of, I'm not going to say the worst case scenario because of course we could have Armageddon and blah, blah, blah and all that stuff, but it's a tough one and it's an unlucky scenario. So we run that scenario and we go, okay, here's what you need to do right now to be prepared for that terrible scenario. Again, the point here is that a recession tomorrow for most of us that are in our accumulating years is not the worst case scenario. The one that you really need to watch out for is the year that you retire. If we have a recession and the stock market tanks, what are you going to do and are you prepared? And there's a lot of things that you can do. And again, running those scenarios brings a lot of those solutions to the surface.
And it's important if you're watching the YouTube portion of this that the statistics that we're talking about here is obviously we're talking a Monte Carlo where it runs through all these different scenarios and fails the engine, as Charlie said, or 2 or 3 or 4 or whatever. And it's just saying, hey, this is, if you don't change anything, this is your percentage of your confidence zone. And obviously with a good financial advisor, financial planner, we're not going to let you get to that point. We will always be looking for ways to make you near that 100% level. And the way you would do that, or we will do that, is we're just looking at, hey, what are your needs? What is it? What some people call the minimum dignity floor, where we're looking at what is it you have to just maintain, some kind of dignified living scenario. And then what we're going to do is pretty much make those fixed. So we want to cover those with fixed assets, either whether that be, pension, Social Security, other types of scenarios, or other types of investments that are fixed, possibly an annuity or something like that. But those are fixed. So then once your minimum dignity is covered, then you can go off with your other investments, your other money, knowing that you're not going to be sleeping on the street. You don't need that money for your food, your utilities, transportation, housing, healthcare, your minimum dignity needs. So don't be so scared, to go out there and use those to your advantage, and you can have more time in the market. Again, like Charlie said, even if you're retired at 65, you have 30 years. I mean, you're not, you don't have to pull that money tomorrow. Even if the economic downturn comes tomorrow, you don't have to pull it. You can have it in there and do very, very well. The power of compound interest over 30 years is amazing. So,
yeah. Ben, what do you think?
Yeah. When I think about, just preparing, one thing that, comes to my mind is making sure you have some cash on hand, you have your emergency fund, you have the basics taken care of, I guess you'd say. And I know we've already talked about that. You've got your portfolio, but maybe you have some other assets as well, that you can pull from, or you can, avoid having to sell your investments in a downturn to be prepared. And a lot of that is what we were talking about. We simulate this and we say, hey, what kind of income do you need in retirement? We're going to make sure you have that. That way, if something, even worst case scenario, instead of pulling from your investments that are down, you're going to pull from other areas. Maybe it's a pension, maybe it's an annuity, maybe it's a bonds. You'll pull from other areas rather than just having to. And that's how we can be proactive. And then maybe when the recession's coming, you're going to be like, well, why aren't we selling our stocks? Stocks are falling. Well, it's because guess what? Actually, you're covered as far as your income. If you don't need the money from those stocks, then why are you worried? And we have the statistics on how often how long these recessions last, as we've talked about already. But we know that these stocks are going to come back in the long run eventually. I mean, we know that companies will perform well over time, and so we can say that for have a few years of income taken care of, and then you don't have to worry as much about the recession. Don't worry about it. So
that statistic again is a recession usually lasts about 15 months, and the average expansion is 48 months. So the Great Recession, even in 2008, 2009, lasted for 18 months, and that was the longest period of economic decline since World War II.
Wow.
So it doesn't happen a whole lot. And I think it's just so important, like you're alluding to, Ben, that you have those different assets that you can pull from during those times. And
in that time, just that time frame really quick, if we saw it last year. I mean, if you were 100% equities, even if you're down, you went down maybe 30%, you were recovered by August. So even if you were 100% stock, you were recovered. That's pretty amazing. That's the S&P 500, of course, we're looking at, but that's pretty amazing. And that's so fast.
Yeah.
And so, I'm sorry to interrupt there, Ben.
No.
I just wanted to make the point too. If you are not retired, right? If you are young or you're still monthly investing or dollar cost averaging, you don't want the stock market to be high. Having lower prices because you're buying, if you have an income, obviously you want that, you still want the job to be monthly averaging or monthly investing and dollar cost averaging. You want the market to be lower, so you're buying more of the stock, more of the company when it's lower. So it's not always great that the market goes up and up and up.
Cheaper percentage of the company. That's what it is. You're buying a percentage of the company for cheaper, and that's what you want.
Absolutely. Yeah, it's amazing. Amazing how sometimes it's counterintuitive, these things, but it really boils down to the basics like we're talking about. Have a great balance sheet, get your debt as low as you can. A lot of people, Rob, I know you're doing it now, but when I was flying, people would say, man, this next downturn is going to be terrible. This next recession, terrible. I'm like, well, maybe you shouldn't buy the new truck and maybe you should save some cash.
I'm stepping on in Florida.
Hey, that's too close to home. I'm hitting too close to home now, but yeah, do the basics and have the basic discipline, and the recession comes along. It's a natural part of the economy. It sounds scary. It sounds like somebody screwed something up when we have a recession, but it's a natural part of the economy. So I'll just, the last thing I'll say before I'll let you all wrap it up is even, we're proactive. We do all the planning. We think about it. We talk about it. We prepare for it. We know what's going to happen. And then once it happens, it's still difficult, but at least we know what decisions. We've talked about them ahead of time. Now, what about when it happens? Do we just sit there on our hands and do nothing? Because we're not going to sell. We'd rather not sell unless the client just can't stand it. And that means we didn't do a good job of evaluating risk going into that. But what can we do once all hell breaks loose, such as last March? There's lots of things. And one of the most profitable things to do is take that opportunity, if you're an equity investor especially, is to rebalance within equity asset classes. Like let's say international does poorly, US does great. Well, you're going to sell some of your US and you're going to buy some international. Now that's really hard to do. Like emerging markets is my favorite example. If we looked at the rate of return right now for emerging markets, it probably would beat everything for the last 20 years, depending on what time frame you took. But long term, it's a great asset class. But when you go to try to buy that when it's low, people scoff. Why are you buying that terrible asset class? It's awful. It's down 40%. Well, it is down 40%, but it's a great asset class. I love it. So anyway, that's hard to do. The other one is think about taxes. We were able to look for tax loss harvesting opportunities. And, there's some rules on that, some tax rules on that you got to follow. But there's a great opportunity there to save taxes, especially if you've got another capital gain that's fairly large and you're trying to exit that position. You could save on taxes by looking at tax loss harvesting, at those opportunities, and they'll show up there in times like last March. And then finally, it's a great time, Ben, I think you mentioned it earlier, to reassess. Hey, am I in the right risk bucket? Am I prepared? Am I handling this okay? Now you don't want to go sell low in the middle of that, but it is a great opportunity to reassess. So those are some things that you can do during, the downturn instead of just sitting on your hands. However, most of the work should be done prior to that. And the last thing I'll say, I promise this is really the last thing I'll say, is that if you're nervous about a recession, think about the worst case scenario, which is going to happen when you retire. You can save a little more and you can negate the effects of that. We've seen it mathematically, not emotionally now. It's still going to be difficult emotionally, but if you're nervous about that situation, we can run the numbers. We can show you exactly how to negate that scenario and how to keep it from affecting your retirement goals. And that's very doable, so that's what we recommend, is preparing for that way in advance. So now I'm really done.
It's great stuff, Charlie. And I just to kind of give people some examples of that asset allocation for the layperson, I guess. You're rebalancing. All you do is you have equities or stocks and bonds, right? 70-30, that mix, whatever it is. And when a downturn happens, your stocks are going to fall, way low, maybe to 50%, 60%, whatever it is. And it's outside of that 70-30 mix that you want. So then what are you going to do? Well, you're going to buy more stocks. You're going to sell bonds. You're going to buy more stocks. And you're automatically buying when it's low and selling when it's high. So that's a great part of asset allocation. And tax loss harvesting, for those of you who don't know it, it's basically when you buy a stock and it goes down, you want to capture that loss, if you will. Charlie, you might want to throw in there, but you're basically capturing that loss and then buying something else that is similar to it. So you still have a good stock in there, but it's capturing that loss on your, tax advantages for it.
Yeah,
so.
You nailed it. There, like you said, there are some other moving parts there you want to be careful to follow that are outside the scope of this discussion. But I did fail to mention Roth conversions. We did a lot of Roth conversions last March as an opportunity. We're doing some anyway, and all of a sudden, if your account balance goes down or that value of that investment goes down, you can subsequently convert that and pay less taxes, especially if you were going to do that anyway. So again, a lot of moving parts on a couple of those things, and don't take that as advice because we're talking very general strategies here. And again, there's a lot of tax laws and things that you need to think about, but there are a lot of things to do is the point of the discussion here. There are a lot of things to do, a lot of opportunities when things get scary.
Yep. Again, rebalance if you can, invest through the downturn, dollar cost averaging, monthly investing, tax loss harvesting, Roth conversions, have solid financial principles to stick to those, avoid bad debt, build your savings, invest for the long term. That's what we're talking about.
Quick thing from the young guys out there, young pilots out there. We kind of joke during last year that, hey, you should be if you're a young person, and this is obviously kind of tongue in cheek, but you should be happy there's a recession to some degree because you can buy ownership in companies cheaper. And we joked about it about me. Hey, Ben, you should be pumped right now. You go buy some of these. You like Apple? Go buy some Apple. Like you just got a 20% discount.
Yep.
Okay. And obviously no one wants a recession, but if you're a young person, take advantage of those opportunities. If you see the market is down, I know it's going to be very tough because it was tough for me. I looked at it, you're watching the news, everything's going to hell in a handbasket, but it's a great time to take advantage of it.
Good point, Ben. And remember, if a downturn does appear, it's only a matter of time before things will start looking up again.
Yeah. And just for those people on YouTube right now, that is not Ben's underoos on his microphone.
No.
Just want to clarify.
I was hoping
that.
we'd clear that one up.
Yeah. We have a problem with our microphones. We need to. We're too cheap to buy those little furry thingies. So those are not Ben's underoos on his microphone.
That is a washcloth?
Spidey.
What is that, Ben?
Allegedly, not my underoos. Look, I had to
Full
find
disclosure.
something to cover it up.
Full disclosure.
Yeah, and apparently it helps with the audio quality.
Yeah, you sound great.
Professional.
I'm gonna
Very,
get
very
some of my
professional.
underoos and put them just kidding. Okay, anything
These
else?
are clean ones, at least.
Yes. All right. Last couple of quotes we'll leave you with. These two are from Burton Malkiel, the author of A Random Walk Down Wall Street. Very smart guy. The majority of investors fail to take full advantage of the incredible power of compounding, the multiplying power of growth times growth. And the second one is, it is not hard to make money in the market. What is hard to avoid is the alluring temptation to throw your money away on short, get-rich-quick speculative binges. It is an obvious lesson, but one frequently ignored. Burton Malkiel there. That's it, folks. We've arrived at our final destination. Let us be the first to welcome you to the end of Flight 14. Thank you for joining us here at the Pilot Money Guys podcast. If you have any questions, shoot us an email, robert@leadingedgeplanning.com. If you like what you heard, or even if you didn't, hit that subscribe button. How about that? So we can reach more people. And remember, the world makes way for those who know where they're going. So plan accordingly. We're out of here.
Thanks, guys.
See ya.